Hello, Face Warriors. How's everyone doing? And welcome viewers at investing.com. Makes me think of the Eagles song, in a New York minute, everything can change. And in fact, I hope that we added value and you're able to lighten up on your stock portfolio last Thursday. In fact, in a New York week, everything did change. So I started in your wheelhouse last Thursday, talked about the fact that Amazon was not making new highs. It could be a failing rally. I showed, quite a few of the stars in NASDAQ 100. Talked about, here's Microsoft. It was making new highs at the time. Look at that. Okay, we were here last Thursday. Okay, talking about NVIDIA, the semiconductors being vulnerable. Here's NVIDIA. Okay, very vulnerable. And I even talked about Apple being the champion that got hammered yesterday. We were talking about, because they have weekly reversals. You don't know till it's Friday, right? Because the weekend's on Friday. And that we were on the verge of some weekly reversals. So here's the NASDAQ daily. Look at yesterday's action. Pummel. But last week, the anticipated weekly key reversal did happen in NASDAQ with real big follow through. Okay, so that was then. This is now. The markets have fought their way back from last night. Wouldn't be surprised if we had some type of reflex rally. There's going to be resistance at 28. There's going to be resistance at 28.40. I don't believe this is the final low. And at the same time, guys, I really don't think this is the beginning of the crash. When you look at the S&P weekly, I've been looking for a correction here. You know, something like this, okay, that looks kind of similar, doesn't it? It may not be as deep. I actually don't think it'll be as deep. But then I think we could put in some kind of base, you know, after this low. I don't know, maybe it's 2660, 2702. Some people are looking for a retest of these lows, and there are even some people talking about flushing these lows if you got 1.6 from here. But I'm not just guessing, it's not just a hunch, but there's a formation I learned about, I don't know, all the way back in the 70s when it was, you know, sex, drugs, rock and roll. It's called a 3-drive pattern. And what I see here is the second drive. So, you know, we do some work here and then later on make an attempt for the third. So this is the second drive. You don't have to have a 3, but I think it is a possibility. There is going to be a lot of repatriation of cash coming in at the end of the year. And you know that these people use if they're going to do a stock buyback program, why not do the buybacks while they're corporate, while their stocks, which is their currency, is getting cheaper. So I don't think the buyback craze is over. So you may ask, where was the flight to safety? There was none in the bonds. So, you know, the old days of when bonds turn out to be a flight to safety, you know, we're still pressing all these highs up here at 318, 320. We are starting to get some divergence, but normally you would have seen yields drop pretty substantially after the kind of debacle that we had in the market yesterday. People were shorting the yen for risk off here. I actually think that there's a chance for the yen to, you know, maybe after one more low, because it's not diverging here, to make its way back up towards this 1340 to 1380 level in the next couple of weeks, which would be a great short, because I think they're much lower levels. And the other event, and it was like a delayed fuse in the metals and really didn't get going until last night, but the gold is now threatening on the daily chart a breakout. So the Columbus Day holiday, I was all ready to buy breaks in gold this week, but when we had this big slam down here, it threw me. We had a pretty lousy reading down here in the RSI, but the daily does look constructive. The bears have been trying to defend this for about 3 months up here, and if we break out 1235 it's possible, maybe even 1280. So metals are shaping up right now. The gold is showing more relative strength than the silver, but maybe silver is carving out a right shoulder here. Here's the left shoulder, here's the head, maybe a right shoulder, here's a neckline. See if my shaky hands can handle this. Okay. Something like this. Okay. So getting back over this 1486 level could send you to $15.50 to $16. So I wouldn't be short the metals in here. Oh, just good music for you, Dave. You're born in 72, don't rub it in. I think we've had about a 6% pullback Forex gal in the equities. And also there's been, I wouldn't call it a big flight, but early in the week for Turnaround Tuesday, I talked about shorting the dollar up here. Okay, we had that reversal day. This is a daily. I actually think there's a chance that the dollar doesn't break all the way back down to here and tries to make a stand here at this 95 level, because before year end, I think there's a possibility that we take out the high of the move, which happened this summer at the 96.80 level. But you can't argue with the week that the euro is having. It's a reversal week, and this too could be a right shoulder, left shoulder, head, right shoulder. Breakout over 118 would measure up towards 120, 121. Okay, so we'll see if that develops, or we're going to get one more flush down and there's no follow through. But a weaker dollar should give at least the multinationals a little bit of relief. We have a lot of earnings coming up. I sound more like a stock guy than an FX guy, don't I? We have earnings coming up. The banks are reporting earnings here at the end of the week. They haven't made much hay on this rise in interest rates. Here's your XLF, but they still look very heavy. Okay, so it looks like this is a failing rally too. We'll see. And you could have thrown a dart at any of the bearish ETFs and done pretty well. Here's a quid. Here's the semiconductors. Okay, all of them. The Russell, we know, was completely massacred. The massacre started a long time ago. But we are back here on TZA. This is a Russell 3 times bearish to where we had a breakdown. So, I'd be booking things here and not looking for a crash. This was a great trade if you took it. But the Russell itself is also, it took out, it's led the way down, so it's taken out a lot of support. And that's really a wrap. I think maybe the next shoe to drop might be what happens in the Chinese yuan, because the Chinese said that they weren't going to weaponize it. And anytime they say they're not going to do something, I normally look for them to do something. So far, it's not happening. It looks like they're trying to defend the yuan here and not so-called weaponize it, which I think the market's not going to like a $7 yuan, so we'll see what happens there. And it's really a pleasure to have everyone here with us. we really hope our mission is to build up and edify traders, investors every day, and hope that investing.com viewers, I think Blake, after he follows me every day on our webinars, and he gave the Roadrunner analogy of the Roadrunners being on the cliff, being chased by Wile E. Coyote. Wile E. Coyote ends up on the ledge, chasing the Roadrunner, and the ledge gives way and falls into a canyon, kind of what we had in the market, especially yesterday with acceleration and almost near panic. We're also reaching some targets in the VIX. So I was thinking 25, and that was Steve Olgey's target coming out of the wedge. So, you know, we could be there today. We're at 24, close enough for government work. I also have a great interview today that you're going to want to stick around for. Peter Goodburn is going to be with us. I've seen Peter make some great calls. I'm going to be asking him about S&Ps, asking him about the dollar, a little on the precious metals and the energy market. So even the energy market fell. Everything was a down day. It was a GMO day. Get me out. So trade safely. You know, you don't have, after days like yesterday, you really don't have to do anything right away. You could wait for the dust to settle. And I've been around long enough to know that it will settle. So Blake, great call you made with Wile E. Coyote falling off the canyon last week. My thing,
it was quite a Wile E. Coyote market, wasn't it?
Yeah, really. You know, I mean, you know, that was a pretty deep canyon floor yesterday. Do you think that he's near the bottom of the canyon, hit the bottom of the canyon, or he's still falling?
I do. No, and good morning, everybody. I actually think we're probably close to. Well, when I say close to a bottom, that doesn't mean. I mean, it's a tradable bottom. I think it's a. I think where we're at right now, you don't want to be short. But I would rather be short than long. So
yeah, I hear you.
But you know, this is the S&P, and this is what I just sent out to ForexAnalytix subscribers about an hour ago. So if you are a ForexAnalytix subscriber, you get analysis on the S&P and some of the other markets as well. This is the chart that I just sent out, and that we're at the 78% retracement. We're going to probably bounce towards 2780, 2790. I think is what I wrote.
Oh, Blake, and I wanted to remind people that if they like what they hear here on Thursdays at investing.com, it's really only the tip of the iceberg to know what the whole team is thinking and looking to possibly take advantage of. Happens almost 24/7, at least 24/6. So investing.com viewers, we welcome you to subscribe and become part of our trading family.
Yeah, we have a really very extensive community, and it's not just the platform. A lot of people go, oh wow, the platform's pretty cool. Oh, I can, I have a mobile app, and I have I can put it on my iPad, and I get all this analysis, and but we also have a community. We have a real big online private community for ForexAnalytix subscribers. You can see there's about 81 of us here right now, and then there's usually about 100 people in here. And yeah, I just put you guys on the jumbotron. You can see some of the traders that are listening in. They're chatting as well, and we have a really nice group of people that are in here, and a very diverse group too. We chat all day. This is where I'm at throughout the course of the day. So if you're utilizing ForexAnalytix, there's and sorry guys, I'm gonna take you off here for a second. There's a little chat button right here, and that launches the chat room, which we're already in. So I'll go ahead and close that. But yeah, it's great. And this is, like I said, this is where I'm at throughout the course of through the day. I'm gonna put back up here, and so not only do you get the analysis, but you get you get our community, and our community is really tight. Some of those people I've been literally talking and chatting with in chat rooms for over 10 years now. So it's pretty cool, you know, and it's a very welcoming community as well. Now, and Dale, just to mention, I know you said you talk a lot of stocks, and I know you do a lot of stock work on the weekends during your own private group. You have the Eagle's Nest. So if anybody is interested in doing some more work on charts on Saturdays, make sure you get a hold of Dale or Forex Stop Hunter on Twitter too, because he has a little private group that he likes to host on the weekends. It's Saturday, right? Did he just disappear? He just disappeared.
I think he stepped up for 2 minutes. Yeah.
Okay. So anyway, okay. So you know, talking about, hey, good morning, Stelios. Talking about the S&P. So we were looking at yesterday morning. We were looking at this consolidation, and when we broke down in the S&P, frankly I did not expect this big of a move. I shorted the S&P like twice yesterday, and through this down move, and scalping it mostly because I did not expect us to really fall out of bed. I mean, when I talked about Wile E. Coyote, I was talking about this little move right here coming out of the wedge, but we really broke down yesterday, and I think the market is, for the most part, it was pretty stunned. And I mean, these are the types of moves that, you know, the guys and gals on the trading desk now, they don't and are not, they're not familiar with, and they're not, you know, used to. So, you know, we've seen a really big decline, and Dale was talking about, you know, how big of a decline did we take off the top. It was about 6.5% from the S&P, a correction, and I don't believe this is the end of the correction either. I think that we're going to go lower, but that doesn't mean that we're going to go straight down. I think we're going to see a bounce and consolidate. I think the market is getting its bearings right now. I think you know, you've got a situation where, you know, what happened yesterday, and now the markets are going to you know, kind of you know, find some sort of base that we can trade off of, and I think the 78% retracement is that. Now a bounce up to, you know, let's just say 2,800 or 2790, I think this is going to be a pretty key resistance on any type of bounce. And how the market responds from here, you know, I would actually be looking to sell, you know, any type of rally, probably going into today is CPI. We have CPI today, but probably going into tomorrow, because any which way you slice it, the weekly candles are going to be really ugly when it comes to equities. So selling later today, possibly tomorrow, you know, the equity market seems like a more logical choice. You have to be really patient. You know, trying to chase it on the short side here is going to be a little tough. Dale, it sounds like you're back.
I am, buddy. How are you?
Good. And I just mentioned earlier that that you do a stock chart group on the weekends called the Eagle's Nest. So if anybody wants to get a hold of you, it is on Saturday, right? You guys do that?
Yeah, Saturday, 11 a.m. Eastern.
Yeah. So
and,
make sure.
The only guarantee I give people is that I'll teach them everything I've learned and know.
All right, there you go.
That's
so
my guarantee.
make sure you guys get a hold of Dale, you know, about what he does on the weekends, separately on Twitter. You're welcome. And I mentioned that a little bit earlier. But anyway, let's talk about the dollar, because I actually just sold some euro at 115.80. It's a 38% retracement. The dollar is a little bit of, and we just had the ECB meeting minutes come out, and that's why the euro is a little higher. Following the meeting minutes, but the euro's been a little stronger because I think a lot of the cross rates are moving higher, and also keep in mind that gold's been bouncing too. So if they're, you know, correlations are kind of jacked up right now. Jacked up isn't, you know, it's not a key term that I like to use all the time, but it's really that correlations in the market are kind of cattywampus. They're just little off, and I think a lot of that has to do with you see the dollar. Let's go into the dollar index really quick. Here's the dollar, and the dollar's been coming down. We're seeing it come off of you know, some. It's kind of a harder index to read, because you're seeing the dollar weaken against European currencies, but you're seeing it strengthen against you know, commodity currencies. Yeah, it's strengthening against commodity currencies. It's weaker against the yen, and so that's leaving the dollar index kind of you know, not. It
almost looks like a pullback to buy to me, Blake, unless we really start closing aggressively under 95. You kind of see it that way?
Yeah, you know, I don't think European worries are past us, and like I said, I just shorted the euro like a few about an hour and a half ago at the 80 level, and I know we have CPI here in about 10 minutes, so which I'm going to be passing it over to Stelios and Steve here in a moment to trade that, but you know, gold is making a move, and you can see that gold. The one thing that I do know is you've got gold that is strengthening. We're getting up towards this big resistance level. This is a big resistance zone, if you will, in gold, and a break above 1213. 1213 in the spot market could boost gold up a little bit, but how's the dollar going to respond? I mean, when we have risk aversion, you could see dollar strengthen, gold strengthen, and even bonds strengthen at the same time. So I'm keeping an eye on gold, seeing what the dollar dynamic is going to be if gold starts to break out. Silver's trying to build a base as well. We got like a inverted head and shoulder pattern trying to form here. That's something that I'm paying attention to, but I'm also paying attention to the bond market. The bond market actually shows a little bit of strength, and if we could break this channel, I think that's pretty key as far as the bond market goes, because bonds have been very weak, yields have been rallying. That's what's the one thing that I think that people attribute to the stock market weakness is we're seeing yields rally, and the stock market's not liking the higher yields. But if bonds start to rally, does that take the pressure off of the stock market, or is it just the ball is already rolling down the hill in the equity markets, and the bond market just starts to strengthen from a risk aversion standpoint? So, you know, I'm going to keep an eye on bonds, especially if the 10-year gets back above 1809 in the 10-year. We see a breach of this channel on previous support. Then you're going to see a rally in bonds, and again, I don't know if that's going to be a result of weaker stocks, or maybe, you know, stocks you know, bounce back, and, you know, the bond market you know, bounces back a little bit too. It's hard to say, but I was going to tell you one of the other reasons why you're seeing strength in, you know, the European currencies and weakness in the commodity currencies is you got currency pairs like the Euro Aussie, Euro New Zealand. They look extremely strong, and that's a pretty good indication of risk off when you have you know, stronger European currencies, weaker commodity currencies. You got the Euro Aussie, Euro New Zealand, Euro Canadian, and despite the Italian woes, I mean, and then you got Pound Aussie, Pound New Zealand that looks very strong as well. These are all signs of risk off, and you know, you have to be careful, because I think the stock market's actually broken. I think, you know, the S&P could see 2,400, 2,500 again. I know I've got little blue lines drawn here on the 4-hour chart, so that they don't translate when you're looking at longer term charts. But I think the S&P could correct even further. And if you talk about like what the distance of a correction like this could be, you're talking a 20% correction. And you know, a lot of people would say, oh, it's bear market territory and blah blah blah, but you know, really it's just correcting the long-term trend line. It's not breaking the market. It's just I think a bigger correction is probably in store for equities. That's why I don't think you should get lured into the, oh, you know, the market's oversold and I'm gonna get long, and this is where you're gonna get long and, you know, stay long. I actually think that the trade war and is just starting to bite in equities now. So I think that you know, the depth of the correction that we see in equities is probably going to be proportionate to the length of the trade war that we experience with China. And everything that I've read is, you know, China and the U.S. are both digging in their heels. This is not going to be an overnight thing. This is going to be China and the U.S. going head to head, probably for for the next couple of years, and if not longer than that. And the fact of the matter is as that relationship is strained between China and the U.S., it's probably going to weigh on equities. And inflation is going to bite. You know, I don't know if it's going to show up in today's CPI, which I think we might see it start to rear its ugly head on a consumer standpoint. But moving forward, these prices are going to be passed on to the U.S. consumers. And I'm not just talking about the U.S. consumers. I should talk about global consumers. So when you buy, you know, your TV, and it's you know, got a 20% premium from where it's at right now, you know, 6 months from now, or you go to buy your washing machine or a dryer or you know, a hair dryer, or you go to you know, your store and you buy clothes and you see them, you know, 10 or 15, 20% higher as a result of a trade war. That inflationary pressure is going to weigh on consumer sentiment moving forward. So I don't see this abating anytime in the near future. So any type of rally that we see in equities is probably going to face some sort of headwinds. I don't think that this is going away. That's why that you have to use these are sharp sell-offs, and I always like to tell people when I'm reading charts, you know, a big green bar is usually followed by another big green bar, and big red bars are also followed by usually big red bars. So, you know, we had this big sell-off in equities yesterday. We might see a bounce over the next couple of days, but that we're going to be met with another big red bar probably in the coming days. And I would assume if you're talking about, you know, the markets, you know, here in the near term, you know, I'm assuming we're going to be met with more selling by Friday, by tomorrow. I think tomorrow, like I said, the charts are going to look really ugly, and so you're going to have people leaning into the equity markets probably going into Friday. So we do have CPI coming up in just a couple short minutes. I'm going to let my colleagues Steve and Stelios take you into that. Into the data, we do have CPI coming out with 0.2% expected on core CPI and the headline number. So it's going to be a pretty important number for the markets today. Good morning, Steve. Good morning, Stelios.
Good morning, Blake. How are you?
Good morning, Greeks.
Hello, Dale.
How are you guys?
It's the Athens team. I'm going to let them take over here.
Hey, Blake, it sounds like you're right back in the saddle after your vacation. It only took you a day. Good hunting, and great to have you back.
Thanks. It's you know, I had to have a day of shaking off all the wine from Napa Valley. And you know, I was really tired yesterday. I was getting accustomed to sleeping like 7 hours a night. So it was tough. So
back to the marine life, Blake.
Yeah, back to being Mr. Robot. All right, guys. Well. Steve, I'm going to pass it over to you. You guys have a great session, and thanks everybody for listening in. And make sure you visit our sponsor, Forest Park FX. They're the ones that make this webinar happen, this free webinar that you guys experience every day. So make sure you talk with them, especially if you're a trader and you don't get some sort of, if you don't get ForexAnalytix for free, especially if you're in Europe or Asia. Check in our reimbursement program through Forest Park FX. It's in this way you can be involved in a community and have your trading pay for it. So
Trent's going to be with us tomorrow, Blake, and
Trent is going to be with us tomorrow.
So I'd like everyone to put on their thinking caps and have questions for Trent about brokerage and what you should look for, ECN, all the different types of brokers that are out there. So be prepared to ask Trent any question you have, because he's an expert. So good luck today, Blake.
Back at you guys.
All right. All right, Steve. So you warned and you warned and you warned about this big decline coming in stocks, and great call. You nailed the high in the Russell. You know, within 0.1% or something like that, and really, and you weren't late if you waited until yesterday. Now you're late a little bit, but great job, Steve.
Thank you. That actually made my month, because it was a very slow month. I mean, I am still stuck with my gold long, which is just barely in the money, because gold, as you know, hasn't been doing anything. Speaking of gold, before I go to the indices,
Yeah, it's shaping up now, though, bro. Monday threw me off. I was coming into this week looking to buy gold, and after that Columbus Day sell-off, I go, that kind of screwed up the charts and what I was looking at. And here we are knocking on the door of a breakout, though.
Yeah, gold is still consolidating here, and we're about to find out what its intentions are. Anyhow, I'm still holding my cost average is at 11.99, but you know, I got that little attempt in the euro pound, which cost me like almost 0.5%. But you know, that short I had in the S&P for so long, I mean, you know, that half of a position that they had established.
Sorry to interrupt. We just had the CPI numbers. They were a little bit weak. Not, you know, 0.1% lower than expected. So
okay, that's why we're seeing actually this bounce in
euro.
That's why we're seeing this bounce in euro. Let me switch to it. By the way, there it is. By the way, if you remember, we warned yesterday about the euro, and specifically, I remember I showed this chart. I also posted this chart at the end of the day analysis and intraday. This one, the day before yesterday, because I was seeing this descending wedge. There was an obvious RSI divergence as well, so this played out very nicely. On the other hand, we also had that stubborn stall in the USD Swiss. So let me go to that as well. There it is. I mean, we had like 4 consecutive pin bars right on the 78.6 for the USD Swiss. We discussed even about that yesterday at the company's meeting, and you know, finally the USD Swiss is showing some weakness. We're now testing the first area of support. I would prefer if I saw even a bigger retracement towards this 97.70, 97.60, 97.70 area, having to do with the USD Swiss. But to be very honest, I would consider, of course, depending on how the price action develops, to that point, but I would consider that to be likely a buying opportunity if we see some kind of a stall. Anyhow, the S&P really made my month, because I had 2 positions established at 29.32 and 29.42. The last one was actually like barely triggered, and I had a stop loss at my cost average at 29.37. People in the chat room know about that. Thankfully, I only, my stop losses are mental, and I only, trigger them if we get a daily close above them. Otherwise, I would have been stopped, a couple of times here in the S&P. So today, earlier in the morning, I actually took profits. That was a 6.3% gain to the downside. I do think that this move lower in the indices has actually broken. From a technical perspective, it has broken the uptrend, at least for a period of time. But I do think that we shouldn't be that greedy. So I think that we should expect that we might see some kind of a bounce before moving lower. Obviously, the first area of resistance is, what I said was a very strong area of support at 27.90. We are already approaching that. Now, on the other hand, if that actually breaks, I think that this previous channel might act as a resistance from this point on. And, I said yesterday that both the DAX and the S&P were at the precipice of big breakdowns, and they said that if they actually, make the move, the Nasdaq is definitely going to snap very fast, and that's exactly what happened with the Nasdaq. We sliced through the first area of support like it was butter, and we've now stalled at the 50% fib. But I do think that there is more downside, and as I was saying yesterday, there is even the possibility that we're going to eventually see a complete retracement to the start of this ascending wedge. Now, from a technical perspective, unquestionably, the most important event was the DAX finally breaking below this head and shoulders formation pattern. If we even have a look at the weekly, you can see how important that is, especially if we only have like 1.5 days left for the week. I think especially if we close on a weekly closing basis below this, people are going to be extremely skeptical about even trying to be long the DAX, because this is like a very clean, very potent formation. So unless the bulls manage to defend this level and prove that this was like a false breakdown by the end of the week, I bet that there is a lot of thinking going to be happening during the weekend, and we might see like a bigger sell-off starting Monday morning. So DAX, very important. As I said, 1.5 days left for us to confirm what's happening here, but I have to say that it doesn't look good at all, right? So having to do with indices, I think the situation is very clear. Let me also mention, we were talking about the potential of, sorry, this is a weekly, I wanted to show the daily. We were talking about the potential about a bullish breakout in the Shanghai composite from this descending wedge. We did see a rebound from there, and then we saw that big day down on that gap, and that's when I mentioned that, we did get a break higher, but the price action, looks again heavy, and this is not a good sign for the bulls, because they did achieve a breakup from this formation, but there doesn't seem to be the required momentum to see some follow through. And look at the horrific day that the Shanghai Composite Index had. I mean, it was more than 5% down overnight, finally breaching through this horizontal support area. If I zoom out, you can see how important this horizontal support area has been. I mean, just look at this, right? It has acted as support resistance multiple times in the past. So Shanghai Composite Index also seems to be in huge trouble here. Let's see what it's going to do tomorrow. But once again, if it closes the week below this horizontal support area, I think that's very bad news. So in general, we're seeing very strong signals that risk is totally changing direction, and I don't know for how long that's going to last. We had also been warning about the VIX. I remember it was just a few days ago that I was saying that we've seen this formation multiple times in the VIX. Just look, another descending wedge here with some clear RSI divergence despite pushing to new highs.
Great target too, Steve. Coming out of there, you were looking for 25, so nice target you had.
Yeah, at 25 was the first natural target. You can see why, because we had a consolidation of highs at around 25 back here. So yes, we did reach that earlier today. So I think this is another indication that we might get some kind of a pullback. Some of the deep buyers that have gotten used to buying all the dips might make an effort to start collecting some stocks at current levels. But personally speaking, I really doubt that such a huge breakdown like the one we had yesterday can just end up being over, after a single day of a sell-off. It can happen, but statistically speaking, that's not the most likely scenario. Now, one more thing I wanted to add here is that obviously the bulls are going to fight, especially having to do with the S&P here. As you see, this is the 200 daily moving average, right? Earlier today, we were actually probing clearly below it, and obviously the bulls are trying to defend it, at least on a daily closing basis. So I wouldn't rule out a positive close today, but even if we pare back even 0.5% or 1%, still that huge candle that we had yesterday is a very intimidating candle. I mean, let's assume that you were bullish even if that means that you were bullish from lower levels and you were in the money, or that you were trapped being long at at a very late stage, which means that you're now underwater. After seeing such an intimidating day like the one we had, it's extremely likely that the more we recover from this sell-off, the more likely scenario that people are going to say, okay, nice. Now let's say I'm break even, or now that we pulled back somewhat, it's a good opportunity for me to book profits, from my longs, because this is likely the beginning of a deeper correction at the very least. So, I do think that we should clearly be looking for, a decent retracement to be selling the index again, instead of anything else. If we actually clear the 2790 area, I think that the next area of interest would be at around 2815, 2817, and above that, it's going to be the 2845 area. Now, obviously, 2862, 63, which I was explaining yesterday how important it is, and we had already seen the market defend that level like 3-4 days in a row until it finally broke, is going to be the ultimate bull bear line, because I have to say that, seeing the day that we had yesterday, you now have to be looking in the opposite direction, meaning that as long as we remain below 2863, you have to be looking to sell any rally, at least in the short term, right? So things have obviously shifted at least for a short period of time, exactly as it happened in January, that, when we saw that initial sell-off there in January, I explained, if you remember, I said immediately, I made it very clear that, listen, I don't know what's going to happen from here. I don't know if we're going to move a lot lower from here, but, at the very least, it's going to take us a long time for the bulls to regain confidence to push the index higher, because, such a sell-off like the one we saw is not something that the market can recover from like immediately. So, the most bullish scenario played out here, which was what? Consolidating in a range for a period of time until the bulls finally felt safer, meaning that they felt like the vast majority of the, let's say, the eye of the storm, the most severe part of the attempt of the bears to actually take control of the index was over. So steadily they started gaining confidence and finally pushed the index to new highs. So I think the same situation is here. I mean, we remain having to do in the long term, we remain in an uptrend. Of course, a very, very bearish day cannot take away a 10-year old, a 10-year bull run. But for sure, in the short term, it shifts things totally. And as I said, the levels to watch are 2790, 2815, 2845, and ultimately it's this 2860, 2865 area. As long as we remain below that, I think that there is more downside coming in the coming days, or at the very, very, very least, we might see some broad consolidation taking place for a period of time before the market finds the strength to push higher again. So I think this covers more or less my view having to do with stocks. I personally don't believe that, at least for the time being, I mean, there is a decent chance that when the next recession comes, or when finally the US stocks start selling off, emerging market stocks might actually do well. That has to do mostly with the dollar, because I believe that if that happens, we're also going to see a big dollar devaluation, and the dollar devaluation is definitely going to act as a positive catalyst for many of the emerging markets. So despite me believing that there is even the possibility that we might see a period that US stocks will be selling off, but not the rest of the world, I don't think that that's the case yet, which means that I don't think that after this kind of a sell-off, you should expect any indices to actually do very well. with divergences, obviously some of them are going to be selling less, some of them are going to be selling more. But obviously, I think that US stocks, at least in the short term, are meant or are bound to suffer more. Speaking of which, as we've been having this conversation, I've said many times how important the 1208 level is for gold, and gold is actually testing as we speak the 1208 level. It's actually probing above it. But once again, okay, I'm long, but that doesn't change the fact that I'm always trying to maintain, a cool head and, an objective view of the market. So I have to say, unless I see close on the daily chart above 1208, I don't want to get carried away. I'm still holding to my long, but I think that closing on the daily above 1208 is what's going to actually mark the next leg higher, in which case I will be looking for 1238 as a first target. So it's definitely something to be watching today, because gold seems to be gaining momentum. Technical analysis is always very, a very important tool. Just look at this ascending trend line from this triangle. It acted as support already, like 2 days there and 3 days here. So, that actually kept me from bailing out of my position. So, this now might end up being, a good trade. We'll find out quite soon. Now, having to do with the rest of the metals, let's have a look at silver.
Actually, Steve, when you're done with silver, our friend Dave is asking about palladium, so it's probably a good time to cover that if you can.
Yeah, silver rebounding from here. If actually we see another leg higher, as I was saying initially, 1520 is the natural target, and here is palladium. Palladium is very strong. I said yesterday, I explained that there are two scenarios for palladium. One more leg lower. The second scenario, a triangle. The palladium market is showing extreme strength. So, seeing one more day higher today, I think that the triangle scenario is gaining even more, credibility. I would be a little bit careful, because we might get rejected from somewhere here once again and consolidate a little bit longer before higher. But it does look likely that we're going to have one more leg higher for palladium, perhaps towards this 127.2 at 1,120. That's exactly what I said yesterday. So, this remains to be the case. Worst case scenario, we might see another leg lower towards 1,000. But as I said, the more the price action is consolidating, the more palladium is consolidating in time and not pulling back in price, the higher the chances that we're not going to get much lower prices, right? So this is the case. And for whoever actually had my advice yesterday and you wanted to trade on crude, yesterday I made it extremely clear that I believe that crude had at least one more leg lower, that in the medium term I remain bullish. This is also what we wrote at the end of the week analysis, and Monday and Tuesday. I very clearly said that price action tells me that the rejection from that nice confluence of resistances is quite important, and I don't believe it's over within like 2-3 days. So I said one more pullback lower towards 72.50 before higher, but that can even take us lower than that to 70 before higher. So let's see what crude is going to do today. But yesterday, within a single candle, we got from there to the 72.50, which was my next target. So I'm waiting to see if it's going to gain more downside momentum, because if it does, then we might be talking about a totally different corrective structure, which might even take us a lot deeper. Anyhow, I was quite clear that I expected, a rejection from where we were trading, and I'm happy to see that actually this happened, because, I know that some of you take what we say here into account into your trading. Although, as we've said many times, we're here to give us our point of view, and That doesn't mean that nobody's always right, nobody's always wrong, right? We just try to interpret the markets as objectively as possible. And, as Dale was saying before, the chat room is also helping a lot with that. We have a lot of exchange of ideas in the chat room, and, our patterns in play are doing good. But, it's not only our patterns in play. We don't want to have people following our patterns in play because we have excellent ideas that we never put as patterns in play, and we have some excellent ideas that we do. And I think that, following the community will help you become a better trader. Also, we keep company to each other, and several pairs of eyes are much better than just being with yourself and trying to track a number of markets. Now, having to do with the Aussie and the Kiwi, the Aussie and the Kiwi are still making an attempt to rebound from here. As I was saying, I remember we wrote on Tuesday that 71 level is very critical on a daily closing basis. We actually got rejected from there once again. Today we're probing above it. So who knows? We might finally close above 71, but that's just like the first little step for a bigger rebound in the Aussie, because what would actually be needed is a break above this channel for something to start happening to the upside. Because don't forget, a lot of false signals, a lot of false hope of like bigger rebounds have all been shot down from this descending channel, right? So, I think you need to remain cautious having to do with that. And the same applies with Kiwi. Kiwi now retesting this previous low at 65, 65.20. Doesn't look bad. I mean, it has reached some downside levels. It's definitely showing some RSI divergence as well since May. So, I mean, look at this prolonged RSI divergence. I mean, we had 1, 2, 3, 4, 5 lows since then, and every single time there is a little bit more of a divergence. So I have to say that, my gut feeling says that there is a decent possibility for a rebound in these pairs. But, the first step that is required here is to see a daily close above 65.20 to feel even more comfortable about that. Stelio, by the way, if we have any questions, go ahead and give them.
Well, our friend Olivier is saying stop the phone from ringing. What's happening with your phone, dude? We've been at cable and Eurodollar. I actually was in a meeting for a little bit, so I've missed some of what you've said. I don't know if you covered or what you've covered. So cable and Eurodollar we have been asked so far.
Eurodollar, I did show the 4-hour chart as well. I think that we can see a big rebound from here. And speaking of which, don't forget that I also showed, besides the Euro USD, I also showed the DXY. If I remember, it was yesterday or the day before yesterday, and I also showed the 4-hour chart here. But the reason being, I definitely also posted that on ForexAnalytix intraday analysis, because this is what we had with the DXY, as you see. I was monitoring this ascending wedge. I posted that in the chat room as well. And, the fact that we broke down from there was definitely a bearish sign. And the fact that, 2 days ago, we had that little false break higher, which completely retraced and ended up being like a shooting star. That was also a very bearish signal, and we're now back down, retesting the first area of support of 95. So let's see what 95 does. But I have to be honest, I mean, the dollar looks like it wants to move lower, at least, for the time being. So, I have to say that if I had to be something the dollar, it would definitely be short, which I am, given the fact that I'm long gold, right? So, I have some short dollar exposure, and that's against gold. Any other questions, Stelio? Oh, yeah.
Let me have a look.
The cable. You said about the cable. Yeah,
yes.
Cable looks good. Cable looks good, but 133 remains key. So Would I be buying it close to 133? No, I won't. On the other hand, if we do break above 133, there is a very decent chance that we're going to see a rebound towards 136. This is what I said the previous time we were testing 133. We got rejected from there. I was actually long cable. I fell into the trap believing that we would actually break above 133. So instead of taking profits there, which was my initial plan, I changed my initial plan and I ended up, with less profits when I actually saw that like big down day. So, that's a lesson as well, that when you have a plan, it's a good idea. More of the times it pays off to follow your initial plan than, tweak it, while it's evolving. But anyhow, my viewpoint back then doesn't really change. 133 remains key resistance. If we do break above it, a very, very decent chance that we're going to squeeze higher towards 136, because I don't have to be a magician. I don't have to be a guru to understand that there must be a lot of stop losses accumulated above 133. So once we start tripping over them, that on its own should be enough to produce some acceleration higher. And speaking of the cable, let's have a look at the gap, because I was showing that in the chat room earlier. The gap is in essence trapped in a range. You can look at it as a range, you can look at it as a triangle. Obviously 147 to the downside and 149.50 to the upside are key levels. Either of that breaks, I think that we should see a very decent extension. So far, given the fact that we had an okay move higher, I think I would favor one more break to the upside likely, and perhaps we can see one more move higher towards this. Let me zoom out so you can see, towards this trend line before seeing more weakness. And why am I saying that? Because you're going to see the importance of this trend line once again. There it is, you see. So, perhaps a break above the triangle, a retest of this trend line. And if it takes a little bit more time, perhaps we will get to the point that this trend line is also going to coincide with this horizontal support resistance area. In general, the area between 152 and 153, very critical for the medium to long term, having to do with the gapping. From a risk reward perspective, if we do see a push higher towards this area, I think attempts to short it, will be worthwhile. That's at least my point of view. If the weight moves higher and it shows some kind of rejection is of my liking, having to do, with how I have it in my head, I might actually take that trade being short. Now, a few words about the loonie. I know that Amanda in the chat room has been in the right side of that. I know we've spoken a lot of times about that, and I know a lot of people in the chat room have taken advantage of that. If you remember, after we got rejected to the downside from this confluence of supports down here and forming that morning star formation, I said, that the higher we move, the higher the likelihood that we finally found a tradable low in the USD CAD. The fact that we've now breached the 130 area adds more credibility to this interpretation. So watch out for the USD CAD, because especially if we break above this trend line resistance, I think there is a lot more upside coming. And I know that I'm running out of time, so I just remembered that there is one more pair of interest that I wanted to show. I expected a failure from USD SEC from up there. I forgot to mention it all these days because we were talking about more popular pairs, but I was closely monitoring it because we had so many consecutive up days. But the last few days were clearly showing some momentum loss. and seeing, you know, this big rejection that came today, I think that USD SEK is also an interesting pair to trade to the downside. I think that any rebound towards 905 will be a nice opportunity to short for at least one more leg lower. So I'm actively looking to gain some exposure there if the market does me the favor and rebounds somewhat higher from here. Coach?
Steve, our guest is having a hard time, can't get in because it says our webinar is full. Do you have another link I can give him to enter?
No, unfortunately, no. We've already expanded the webinars. No, I think we can't actually solve that problem until the webinar is over, unfortunately.
Oh, that's too bad.
Yeah. Because we tried with Stelios just before we've expanded the webinar's registration limit, but as it seems, it hasn't taken effect for some reason, so we need to contact them and see why.
So I have to reschedule Peter then?
Yes, unfortunately you do, because really I have unless we can give Peter the link of somebody else's link to join. Give me a second. I might have a solution for you.
Okay.
I'm going to give him Andres' link so he can join with that. Okay. So we can.
Put it in our Skype.
I'll put it in Skype. Just give me a few seconds. Okay.
Okay. Thank you, Steve. I knew you'd figure out something.
There it is. So putting it on Skype and tell him to join using that.
Okay.
There you go. I just sent it to you personally.
Okay.
Okay, he will be able to join with that for sure. And then you will find him as Andre Cardozo, okay?
Okay, he'll be Andre. All right.
Yes.
Thank you.
My pleasure. So you see, there is always a solution for something. So anyhow, that gives me a couple of more minutes then, so we can go a few. Yeah, okay. So let's cover a couple of more pairs until he joins. It shouldn't take him more than 1 minute. I already showed USD SEK. I said that, you know, a rebound towards 905, I think is a good shorting opportunity. This daily candle, just look at it. This daily candle has already covered the price action of the previous 5, and that usually says a lot. I just wanted to show USD NOK as well. USD NOK currently finding support at the first support level. So, you know, what happens from here, in my opinion, is important. I expected a rejection from anywhere between the 50% fib and the 61.8% fib. He just needs to put that link in his browser. He doesn't need to do anything else, Coach, by the way.
Okay.
You know, anywhere between 50% and 61.8% fib. So, you know, if we are to see new lows, we first need to clear this 820 level to the downside. So I'm looking forward to seeing what's going to happen from 820. 820 is already proving that it is an important level to the market, because this is the second consecutive day that the market is actually, you know, attempting to hold it. And, you know, the other pair I wanted to show, and I had shown it a few days ago, is CAD yen, because look at this major rejection from CAD yen, right? Just look at this channel. And if we zoom out, you can also see how important this is, because this channeled recovery came after, you know, the breakdown from a very big corrective formation. So this is like a huge pennant. We actually broke down in an impulsive fashion, and then we recovered in a channeled correction, and, you know, finding this confluence of resistances from this channel and the 78.6% retracement We're now seeing a move lower, which already looks somewhat impulsive. So I believe that any rebound towards the 87 area is also a decent opportunity to be on the short side. So 87 remains key.
Everything so Steve, is Andre's registered name Andrew Ray's Sink? Or because I'm looking for Peter, he says he's in, but I can't find him. I put up Andre. I don't know what Andre uses for his registered name.
Let me do that for you then.
What a team. Go team, go.
Hey, Dale, can you hear me?
I can hear you, Peter.
Good, good.
Oh, okay, great. Can you share your screen?
Yeah.
Steve's going to hand it over to you. Thanks for your patience. And Steve, thank you so much for working out the kink.
There it is.
Okay.
I passed him the screen as well.
All right, so all you have to do is use the drop-down, Peter, to share your screen, and we're ready to go with so many things to talk about. Welcome back.
Thanks a lot, Dale.
And I was going to start with NASDAQ. So really, Peter, you know, I just want to introduce you to the crowd. I've been interviewing Peter Goodburn for, I think, at least maybe 5 years now, going back to the FX Street LAR days. And Peter's made some amazing forecasts. So, and I remember a lot of them, even if like 3 or 4 months pass before we talk again. So I could see what you're showing here right now, Peter, is a question I've been getting. Okay, you know, people, even people who aren't in the business, people that know me, know, you know, I'm kind of a bearish guy. So, you know, they turn on the news, brother, and they go, oh, the Dow's down 1,800. So I'm getting phone calls, and people are asking me, Dale, is this, you know, the beginning of something? And I was telling people yesterday that I thought it was just a top, not the top. So that's a question I have for you, and your charts seem to show that we might have some more left, but we could first trade down under 6,000. Is that what we're seeing here on the NASDAQ?
Yeah, that's right, Dale. Thanks anyway for bringing me on your calls today, because I mean it is timely, isn't it? I mean, we've had a big drop yesterday, and of course everybody's interested in seeing where we go from here. I just thought I would go back a stage further before we take a look at some real-time stuff, and go back to this particular chart, which was dated April 16th, because it holds clues as to why we're seeing, you know, a decline like yesterday. From an Elliott wave perspective, of course, we're looking at pattern structure, but here at WaveTrack International, I like to use a lot of fib price ratio techniques, which I've developed in the last 25 years, to try and pinpoint down where these exact turning points might come from. Also, just to define a pattern. Actually, it's not as easy as you think. I see, you know, a lot of general mistakes being made just because a pattern is being misconstrued.
You know, you bring up mistakes, Peter, and none of us are perfect, right? None of us are right all the time. And I remember, I think it was back in June, we had a 5-wave decline before we made one more high, or maybe 2 more highs in NASDAQ. And you were pretty convinced, because it was a 5-wave decline, that, you know, we were on our way to targets that you're showing here. But unlike a lot of people that probably would have had to wait for that high to be taken out to be proven wrong, that midstream, what was it midstream before NASDAQ made another high that you said 7620 was next, I heard, and you know, and then eventually 7700. But when an Elliottian is convinced, because they get a 5-wave structure that tells them there might be a trend change, and that turns out not to be, what was it on the advance after that initial decline that told you you were wrong and there are new highs coming? I'm curious.
Okay, well, let's address that. First of all, the overall structure from February was considered to be an evolving zigzag, 3 price swings up. We would make, the idea was that back in April, we would make a higher high, and then the market would collapse in wave C, which is the third sequence of an expanding flat, and it ultimately would break below the February low. So that was the model at the time, and we were fishing around trying to find out exactly where this final leg would begin to end. The 38% extension levels that we saw just now on that chart from April were taken out around this area here.
I see.
We started to break it around here, and then we got all this mess. And this, I admit, was quite tough, because you're not really getting any unequivocal confirmation at this point in time. There's no clean 5 decline, any of those pullbacks. Maybe this one in early August, late July, early August. That might have been a bit goofy, and I remember that quite well. But I have to say that if you're going to conduct Elliott wave at this level, you never rely on sort of analyzing one index like this, like the Nasdaq. You're going to be looking at a cross-reference, and I always do that. So
was it the Russell that gave you the clue because it was leading before the top, or was it the Dow? The Dow took over leadership for a while. Was it that?
Well, actually, it was the S&P 400 mid cap, and it was also the value line, which I thought was a broader measure of index. I can show you those actually. Let's take a look at, say, I've got. Let me just put a page number in here, and we'll take a look at that, because okay, here's the 400 mid cap. Okay, the mid caps.
Okay.
And you get this very distinct, let me put a pencil in here and I'll draw it, but you get this very distinct 3 price swing event up from February's low. So you come up here like this, you pull back, and then you get this type of effect. And when you see 3 price swings and you're only just moderately breaking above a previous high like that, that's an alarm bell. You always must consider your Elliott wave default thinking must be zigzag for an expanding flat. It's basically training. It's almost as if you're going through the motions. You don't even question it. You just examine that pattern sequence and you say, okay, 3 price swings, break a previous high. Is it likely to continue? Or if it starts to fade, we've got the first signal. Certainly, if you start breaking back below that high, that's
it's like a false breakout to me. I'm not an Elliottician, but to me that would be a breakout failure. And those are some of your best trades, because everyone gets wrong-footed. They buy the breakout looking for a big leg. What I have found is when you take out a big resistance level that has kind of a flat line of resistance, and the market gives you 2 weeks to buy the breakout, be skeptical.
Yes, I mean, obviously, if you can see a very strong impulse pattern here from an Elliott perspective, this wasn't really strong, much stronger than this. One of my test periods for these types of things is doing something like this. We'll select a 61/8 ratio, and we'll simply extend the initial February upswing like this by 61/8. And normally, if you think like a third price swing sequence has developed below that type of ratio, and then it starts to reintegrate below the previous high, you know that's not necessarily a third wave, because it just hasn't had the power relative to the first wave here.
Right.
Okay, and that's a very good proxy measurement. That will tell you whether or not there's some funny business going on, whether this is a sustained breakout, which will eventually develop into a 5-wave impulse, or whether it's going to be a false breakout, as you say, and it will define a zigzag upswing rather than a 5-wave development. And
I'm curious, Peter, did the Russell give you a clue? As you know, a lot of people were piling into that because they felt it was a safe haven. It's really a joke, a safe haven because of tariffs, and it outperformed all the other averages, making new highs while the other averages were not. But that kind of had a false breakout too. It looked like it was a 4 kind of a triangle and had one more thrust to the upside, and then back underneath the breakout, it just has really led the downside, don't you think?
Yeah. Well, actually, the answer to that was probably no. It didn't give quite as nice clues as maybe the S&P 400 mid-cap.
Interesting.
And the reason being is because look at the movement up in from February's low there relative to that one. Now this one, whereas the S&P 400 mid-cap was only marginally larger than this initial upswing, this one's actually stretched. It's what we call, it has what we call expansion properties. It begins to expand the price range. And that was a tough call because you could, looking at that in isolation, without comparing it to anything else, you could say, well, hang on a minute, that's big enough relative to the initial swing in February. That's big enough to be a third wave. And this could be just a fourth and a fifth. So in the last couple of weeks, since we've been seeing this high, we've been watching how the Russell has behaved, because if there'd have been a nice succinct 3 price swing decline, in other words, ergo a correction, we could have suspected that this was just a mild correction and it would start to run up. But actually, we've been telling our own subscribers in the reports in the last 2 weeks that this decline has got no clues whatsoever to tell us that it would be a correction, and therefore it would be likely to accelerate downwards. And if it did reintegrate back below the January high, this would be very bearish. And it would, even though it did have the qualities at one point to look like a third, it was big enough relative to the initial upswing. It really went back to bringing us to the fact that this would be still a zigzag, not a 1, 2, 3 pattern in a development to the upside in 5 ways.
Don't you think, Peter, guys like us that are always trying to figure out the jigsaw puzzle, regardless of the methodology, will not have to do brain exercises like a lot of older people do to stay sharp?
That's gonna,
because we're always trying to
business.
We're always trying to put the pieces together, right?
We're never going to get dementia. That's never going to happen. No, we're far too active mentally to come on.
Yeah, so a lot of people would take their power of attorney away from me if they thought I had dementia. I might be way out in left field, but no dementia yet. So, I'm getting the drift that, almost every index that you showed before we resume the uptrend, we're going to clean out the February lows and create a lot of panic, and that's going to be a great buying opportunity that a lot of these pullbacks are for. Am I interpreting it correctly?
Yeah, no, absolutely. I mean, it does look like that. I mean, we can always hypothesize that actually this current sequence down is part of a triangle, in which case it wouldn't break the February lows. But I think it's way too big, this drop yesterday. It's looking very much more impulsive. This is the Dow Transports, by the way.
Okay.
And you get the same sort of impression. Look at this. Look, you got the initial upswing in February. You got a bit of a complex sideways there.
It didn't seem impulsive then. Yeah.
And then this is not really impulsive action. And it modestly took out the previous high. Started to drop down. It was one of the first to start dropping back below January's high. These are little clues. I mean, they if you're not doing it well, probably tough. But I mean, I know that
Go ahead. I'm sorry.
I know the advanced decline. The breadth of the market's been waning, but it's been waning since July. So that wasn't really a timing clue. But these are.
I know, because I was early on some bearish ETFs, so I wrote a lot of things out and added and everything. So I actually, do you think there's going to be some type of short-term rally because we're at some support levels here to possibly get on board?
Well, I was looking at the Nasdaq futures this morning, during the Globex hours, and I felt that. Well, let's take a look. I've got this is one of my worksheets that I work from before these go to production for our reports, but I'll show you them for what it's worth. And let's take a look. I think this is the short-term one I want to show you. And well, look here. This is the decline.
Right.
And I figured that this was 5 ways down, and I'm looking really for a correction. And I measure from that high
Not the high of the move, but the high right before the crash. Okay.
Yeah, that's Tuesday, and this was, and you can see that if we put in some standard fib price ratio retracements. I don't rely on retracements so much as everybody else does, because actually I work with fib extension levels within the pattern that's developing. If it happens to coincide with some retracement, all well and good, but actually retracements for me are notoriously, they're not so recurring as I'd like to think. But in this case, it's done a good job, because overnight you can see that the initial upswing is 3 price swings. It's hit the 23% area. That now that we've broken that, it should mean that we'll get up to here a bit later tonight or tomorrow morning, probably tonight.
Okay. You know, I interview a lot of guys, and there was one guy saying that it was looking for a wave 4 in the NASDAQ to 6920 because that was wave 4 of lesser degree before another high, but that may have changed after we made a new high. I actually have an Elliott wave joke for you.
Oh yeah, go on.
Okay, since I mean, you know, you live and breathe it. Why did Elliott wave all the time?
Why did Elliott wave all the time? Yeah, go on. What's the crunch line?
Because he was impulsive. But don't worry, his wife was corrective. All right. So,
I like it.
Anyway, I made it up, so that's why it's not so great. But anyway, you know, I'd like to move on. Kind of have the picture here. Great analysis of the indexes here, Peter. We all appreciate you edifying us. But I do remember last time you were on, and there were still quite a few gold bulls around. And you had a very bearish forecast. I think you're talking maybe 1120 or 1050 into October or the end of the year. And you know, right now it looks like it's trying to threaten a little breakout here above 1208. I was thinking maybe 1235 to 1260 first before we head down again. Are you seeing that as a possibility, or we may just fail here from this 1208 level? But that was a great call.
Well, thanks.
It kept a lot of people away from the pain of owning gold shares and gold as well.
No, great. Well, thanks, Dale. I pulled up this chart. It wasn't too long after we spoke, and this was dated June 15th. And we started to get a breakdown, you know, from the secondary high. Don't forget, there was 2 very similar highs that we had this year. One was in January, at 68, and then this secondary one at 65. Actually, I modified back to the 68 level in January. A bit
I
later
remember, Peter, even back then, when a lot of people were talking about that we could get a breakout over 1365, and they had all kinds of measurements, 1450, 1500. You said, even if that does happen, quote unquote, I believe it'll be a false breakout. So even up there, when the market was very bullish gold, looking for like a bullish formation breakout, you were skeptical even if it would have happened. Really good call.
Yeah. No, thank you very much. The reason for that was because we had a lot of overlapping sequences from the original December 16 low, which was 1122.98 in this advance, and it seemed too corrective. Again, you know, if you look at an initial downswing, you can't see it here. Let's actually look at, before I leave this chart from June, I just wanted to tell you that the third wave low was measured down to 1157. We got to 1160.
Yeah, in Asia, I remember that. Yeah.
So I just want to show you, this was based off some fib price ratios that we use as a technique to develop a third wave where it would finish. And I just want to highlight that to everybody that's listening, because these ratios are very, very important. If you're doing Elliott wave and you like Elliott wave because of its predicted value and it's a forward-thinking sort of concept, you must try and learn and integrate some fib price ratios to your work, because that will give you a pretty good idea whether you're on the right track or not. But anyway, let's take a look at gold. And this is my current goal, which I send to our subscribers twice a week. You can see now, actually, let's pull that one away, and you can see the bigger picture now.
Yeah, so you are looking for a rally towards 1240.
Yeah, this is the fourth wave rally. Now that fourth wave rally is, you know, going back to that June chart. This is the fourth wave rally here.
Yeah.
This one here, originally from 1157 something, and here's the low 1160, just a couple of dollars away. But here's the fourth wave rally, and it needs to trade up to about 1240.
That would be equality from the first rally from 1160 was 55 bucks, I believe, and from the recent low at 81, that would take it to 1236, 1240 for equality.
Yeah, that's it. That's the equality ratio I have on this log scale. That comes in at 36, so that's just a few dollars away. Correct?
Yeah,
That's perfect.
Correct.
And the other thing, I had another target which is based off a slightly different way of ratios. Now we do some back-forward ratio relationships, like reverse engineering. We know that ideally this is you see this pattern is a flat. Now for those that aren't familiar with Elliott wave, the flat is subdividing 335. You get three main price swings, which begins the correction. Then you get 3 or 7 price swings up to reattempt the highs. So you have to watch to know whether this is a high or not. You have to ensure that this is overlapping. It's 3 or 7 price swings. If it is, you know there's going to be a 5 price swing event to the downside, something like this. So this is just basically a flat. Very simple, standard textbook stuff. Now,
yeah, it's interesting. It's going to stop at the lows at the end of 2016.
Yeah, that's it. So in theory, what should happen is it should run up here and stop there. So what we've done, some reverse engineering now, okay? So what we're going to do is we're going to take, we're going to put in a 61/8 ratio in here. And what's happening is that this fourth wave should stop at a relative point that would enable the subsequent fifth wave decline to stop at 1122, that horizontal low. So now it should be a 61/8 ratio of 1 to 3. So first of all, we measure 1 to 3 like this.
Nice.
And then we simply add it, look at the bottom level.
Right.
We're going to add it to 1122 and stop and click it to link it in. And that comes to 42 3/4. So we've got 36 on the equality ratio that you just suggested.
Right.
We've got 34.5, I think, is a 38% correction of wave 3. And we've got 42.75, which is based off this one, this reverse engineering process. So we've got a pretty tight range of probably something like $6 to $7 where this next upswing will stop, and then it will come down again, and we'll finish the conclusion somewhere year end or January.
Okay, great look. So why don't we go to something that it was interesting. Gold was rallying while the dollar was, still showed strength. We could either go euro or dollar. I do remember you had a dollar forecast that, depending upon at that time back, I don't know when did we talk, in June or July, you had targets possibly, there it is, up around 99. So but you think that this correction isn't complete and we could still trade, well, we did trade 93.48. So are we already on the dollar is going to move opposite to gold? So while gold's recovering, the dollar is going to be heading up towards 99.91, or because the chart on the right isn't showing October. Okay. I see.
The one on the left is probably more succinct for this. This was done on the 26th of September, so it was a couple of weeks ago. But what I wanted to show you was how this correction down from 96.98 was developing. It's a 3 pricing event. We had a little 5-way structure down here to 94.44. And on this date in 26th of September, we recognized that wave B was unfolding into an expanding flat. And that this low at 93.82 was proportionately too short relative to the initial downswing from 96.98 to 94.44 to complete the zigzag. Okay, it was too short. We needed, if it had have dropped lower down to 93.48, 92.90, around this area, it would have enabled then the next sequence up to 99.90 to begin. But it was measurably shorter. plus the fact that when the decline unfolded from 95.73 to 93.82, we could see that it had several overlapping sequences, which was inconsistent with this being the completion of the zigzag from August high. So we knew that this was an expanding flat. This would trade up to about 96.04. Well, hey presto, last week the high was 96.12, and we've subsequently started this drop now down to this original level down here.
That's right.
I'll show you the real-time chart now. So let's move across, and yeah, let's take a look. And now you can see that 93.82 level. Here it was. We had 96.04 as a target. Got to 96.15, and bang, there she comes down. She's beginning this move now. Look.
Right.
Okay, so this decline, okay, for the moment for the dollar, this sequence here, it's about 3%, which will allow gold to trade up to our 1240 number.
Interesting.
Now,
okay.
When gold gets to 1240, we expect the fifth wave down to 1123, right?
Right.
And that's where this next swing up develops to 99.90. So this movement from 93.5, it's probably going to get down to 92.90, I think. But once we get down to there, we go up to 99.90, and that's going to be the fifth wave decline on gold down to 1123.
Right.
So
Okay.
these two are very much intimately linked. Reverse correlation, of course, and
right.
That's being maintained, I think.
Okay, that thank you for that. Excellent. I also recall when crude was in the 40s and 50s that you were looking for, you said the mid 70s were going to be quote unquote sticky, and it has been. You know, we had that one pullback from 73 or 74, and now another pullback from the recent highs. So curious what you're thinking about in the oil here, Peter. And that was because I know long term you have some astronomical numbers.
Right. Yes. Well, crude oil. What's happening with that and Brent is that let's look at this chart. Now we have to go back to the lows in February 16. Now, for anyone that's listening and hasn't or isn't familiar with our work, when we got to the lows in 2016, we saw what we called an event happen. We called it the grand resynchronization because we had all the commodity markets finishing their 5-year declines from the peaks in 2011 at that time, including oil. There was a fantastic 3 price swing event from the all-time highs, which was, well, I think, July 2008, when it was up at 137. We had a fantastic zigzag measurement down into that February 16 low. And we also had things like copper finishing its low. We had gold, of course, finishing its low at the time, maybe a month or so before. But basically, you look at that, and also the emerging markets finished their declines. So there was this major event happening, and it also coincided with the major markets, the major indices like the S&P 500 finishing correction declines at that same time as well. So we knew with a very high confidence and a very high conviction at that point that we would start to kick on upwards. And if I go back,
I could verify that because I remember you had at that time price objectives of 2740 or so that seemed crazy to me because we were trading under 2,000.
That's right.
We were about at the 1800 level back then.
That's right. And we felt that the inflation pop scenario, which we have had going since 2010, when the central bank started to turn the wheels, that this would ultimately result in some massive price increases right across the commodity board from this low. Now, the advance is taking form of a zigzag. So we have wave A up here into the June high. B was a running flat. So you come down in 3 waves. Here it's a bit like, what we've just looked at the beginning of today's session when we've discussed how B waves break a previous high and then they drop back down again.
Right.
This one didn't develop into an expanding impulse and break this low, but it did come down quite a bit. And then we get wave C moving up. Now, we had two original upside targets. Once wave A was affirmed here as completing, we could then have some measurements for wave C. And what we do is we simply extend this by 61.8. And sometimes, if we go to a higher high in the B wave here, we can sometimes extend that by 61.8 to yield the completion of wave C. And when we go back to this high, which was in July, we thought, oh, hang on a minute. This is reaching very close to this number at 78.90. Could this be ending the complete sequence? And we weren't certain, but when we started to drop back down into this August low, we could see 3 price swings, and it was very much confirmed in the Brent. So we knew that the probability was that we would again extend this sequence up, and we would then attest to this $88 area. And that's still in play today. Now, I don't think that we're going to drop down dramatically until we get to that number now. So whatever we do over the next month, we will still have to trade up here. I'm pretty certain of that. This upswing that you see here from August low, it's a little bit 3-wave-ish at the moment. And I'm waiting to see if we can see some nearby support for oil and it to turn back up. Let me just put the short-term chart back in, see if I've got it. That was that chart there was the 3-wave pattern on Brent. Look at this, which brought in the affirmation.
Yeah, Brent outperformed.
Yeah, it did. It did. It was really good call, that one. Let's take a look at. I need this other chart. Let's see where it is. This is it here. Now, I'm testing this at the moment to see if this week's decline is a 3 price swing event. Now, I had targets last week down to 71.66. Today's low was 71.63.
You better clean it up.
Yeah, I mean, if we start to break below here,
points, Peter, I'm canceling my subscription.
Good, yeah, you have every right to. Money back guarantees, okay? Money back guarantees. But you know what I would say is that if this gets penetrated, it's going to break the upside momentum, and I don't think I'll be coming out of my own long positions below this low. Now I may have to trigger that in the next hour, but I'll be quite happy to do so, because I think the risk is that this is another 3 price swing event that breaks the previous high, which is here. And it does a 5-wave pattern, an expanding flat. And I don't want to be around for that bigger move. So I'd rather neutralize that risk. But you see, if it does drop down here a little bit, it doesn't affect the concept of still going up here afterwards.
Okay, got it. All right, so yeah, we're either 3 waves or it could be really sharp. That would actually probably add to the bear case in S&Ps, because oils aren't a big group, but I don't think it would be helpful. That brings me to, I'm going to ask you to stretch it one more time and give just a quick look at what you see for 10-year yields, because that seemed to have been the trigger for everything that's happening here.
Yeah, isn't it amazing? I mean, 10-year yields have been inching ahead. We've seen recently, the largest speculative short positioning in futures.
It was contrary to that, and it kept going. It shows you that commercials can be wrong.
Well, that's it. The thing about commercials is because they're a commercial position against a hedge, and therefore there's no significant leverage for them. A leverage makes all the difference, of course. They can sit there and eventually they will be proved correct. But how long before? It's a bit like a divergence in the breadth that we've had recently. How long do you wait? Those guys will eventually come good and the specs will lose their money. But how long before it happens? Now, I think it was a very important break above the May high. Now, I have to tell you that at the May high and this drop that followed afterwards, when I examined that direct decline, I really thought that was a 5-wave impulse pattern. And the best intentions given, that should have prevented a break above this high, but it did break above. So Elliott wave can sometimes let you down. You can blame the analyst. That's fair enough. If if there's a very good reason to think that that could have been 3 waves, then we put our hands up and say no, that was a misdirected call. But it has broken the highs. But the bigger impact here hasn't changed, and that is that all we're doing is prolonging this primary 5th wave that began from September last year. It's a 5-wave sequence, and it happens to be the 5th wave within the course of the movement up from July 16. Now, I still think that this is coming to a completion around 336. This happens to be a 38% correction when we go back to the 1981 high, but it is based off a logarithmic scale, okay. I have to say. Okay. I think there's a lot of resistance up there, and in the short term, I'm thinking that the yield can drop like this in a bit of a 4th wave subdivision before we get that push. But
yeah, maybe that happens with the S&P's flushing Feb lows. A little flight to quality. So
yeah, I mean, proportionately, this is a fairly small move compared to what we've seen on the S&P, isn't it?
Yes. Yeah, there was no flight to quality. No. So that's kind of saying that, the bear market in bonds is real. Otherwise, a day like yesterday, you would have seen yields drop, 10 basis points, 15 basis points in the old days. Now, the funniest thing I heard, Peter, in the last year on CNBC, the week before the drop in NASDAQ, the S&P was weak and the Dow was weak, but NASDAQ was flying, before it topped. And an anchor on CNBC said, investors are buying the FANGs in a flight to safety trade.
Flight to safety. Wow.
I had to keep tweeting that. Wow. I knew we were so close when I heard that the FANGs were.
Actually, I wish I'd said it. It would have given good publicity, right?
Anyway, so I've been tweeting that the flight to safety trade and the FANGs have been under.
Where was he in the late 90s? Where was that guy in the late 90s who said that?
Yeah. Anyway, whoever those investors are, they're going to learn what safety is. What a great interview. What a great interview, buddy. Once again, you never disappoint. Do you want to show people how they could find you and your website and your subscription offers, etc.?
Thanks, Dale. I appreciate that. Yeah, well, first of all, this is our main website, wavetrack.com. And one of our main publications is the Elliott Wave Compass Report. You can go here, subscription, and if you scroll down to the first block, you can see it. It's $39 US a month. So and you don't have to sign up for anything more than a month if you don't want to. And what you get is something like this. This is the Elliott Wave Compass Report. You can download it, or you can view it online in our special Elliott Wave analysis platform. And we publish this twice a week, and you can get the S&P, the Russell, the Dow, everything we've talked about today, plus a few extra things. And there's plenty of charts to view, and we put a lot of inserts in, and this goes out twice a week. So it would be great. If you're interested, then please sign up. We'd be loving to welcome you.
Yeah, one of the hardest working technicians I know, Peter Goodburn. And Peter, thank you so much for coming in and crystallizing some things for me to process in the weeks and months ahead. I hope pips rain down on you and all of your subscribers, and let's get back together in the winter and see how things are, playing out. Thank you so much, my trading warrior brother, for taking time out to edify the FACE community today.
Great, thanks, Dale. I really appreciate it. It's great to talk to you as always, and hope to do it again soon.
And don't forget my Elliott Wave joke. You could tell people, why did Elliott wave all the time?
I'm going to tell all my buddies, don't forget.
All right, buddy. All right, Peter, thank you so much. Everyone, that's a wrap. Thank you, viewers from investing.com. And we'll see everyone tomorrow to wrap up the week. TGIF and Trent from Forest Park FX will be with us if you have any questions about brokers. So again, Peter, thank you for your great work that you shared with us today. And thank you everyone for your attention. Remember, most of all, don't just count your pips, count your blessings. See everyone for the wrap up TGIF tomorrow. Thanks again, Peter Goodburn.